Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show Perspective broadcast. Welcome, friends. Jeff Bernier here again with our periodic conversation about money and meaning and wealth management topics, as well as things that can help you get your actions and resources in alignment with what really matters. So that's what this show is all about. These Perspectives broadcasts are really designed to give you a little bit of perspective on financial planning in the capital markets and investment planning and things of that nature. So let's just jump right in. Since the Great Depression in the 1930s, there have been 14 recessions, according to the National Bureau of Economic Research. Therefore, you can expect a recession, if you do the math on this, about every 6 to 7 years. According to many research studies, the average retirement today for the average American is about age 62. Other data points, according to J.P. Morgan's Guide to Retirement, there's about a 73% chance that a married couple, age 65, that at least one of them will make it to age 90. There's about a 43% chance that one of them would make it to age 95. So let's put all that together here for a moment. So if we assume a 62-year-old retirement, an age 90 life expectancy, and a recession roughly every 6 years, my 62-year-old new retired client has to be psychologically prepared for roughly 5 to 6 recessions over their retirement lifetime. And as an aside, each of these will be reported as the end of the world or this time is different and certainly unprecedented. And of course, I bring this up today because there's discussion about potentially a recession and economic downturns because of some of the things going on. And as you know, a major theme of these communications is not to let current events affect rational long-term planning and rational long-term investment policy. So your long-term investment policy should not be driven by current events. And of course, today's current events are quite uncertain. The combination of a blizzard of policy pronouncements by the new administration, fears about inflation remaining persistent, a reassessment of large growth tech stock darlings. Their valuations have obviously come down significantly recently. All of that has created a lot of uncertainty. And of course, the talk of recession and economic slowdown and all these policy pronouncements. So no one knows what will happen next in the economy, in the markets. And of course, that doesn't stop people from predicting and forecasting and showing up on major news, business news, making forecasts. But they all have one thing in common, and that one thing is that none of them know. And I certainly don't know. So what is a long-term retirement income investor to do that has to be psychologically prepared, as I mentioned, for 5 or 6 recessions over their lifetime? Well, in times of great uncertainty, it's really helpful to go back to your long-term financial plan, your first principles, and staying broadly diversified. That's your best defense. However, one of the key challenges to the diversified investor is what I'll call line item thinking. And I got this concept and this idea from Joe Wiggins. He wrote a terrific blog. He's got a blog called the Behavioral Investment Blog. And he wrote a blog back in February called The Perils of Line Item Thinking. And so I want to talk a little bit about some of his points, but the major idea here is that we've got to make sure we stay broadly diversified, and line item thinking can be a challenge to that. But before I go through a couple of his points, let me share a little bit of financial data just to give you some ideas of what I'm talking about. So the first illustration I'll use is just comparing U.S. stocks to international stocks recently. So if you just, and I'll just use Dimensional Fund Advisors' large cap U.S. core fund, and I'll just compare it to their core international fund. Going back to 2005, the large core U.S. fund is up 526%, far exceeding the international fund, which is up 186%. So, and this goes back to 2005. And so if you look at that, someone who was doing line item thinking might say, why do I want international? Why do I want that line item in a diversified portfolio? Well, year to date, we see the reasons we want international diversification. And of course, we've talked about it a lot together on these shows. Year to date, their international fund has beat the U.S. fund by 11% year to date. So as I mentioned, the U.S. fund is down about 4% year to date, and the international fund is actually up 7% year to date. So that's an idea of why you don't want to do line item thinking and just focus on the individual line items. We could do the same thing when we compare an asset class like small value to large core. So year to date, small value is down about 8%. Whereas I just mentioned, large core is only down about 4%. So year to date, you might be looking at your statements and say, why do I want small value? It's down 8%, where the large core is only down 4%. Well, if you go back to the pandemic bottom, which is March of 2020, from the pandemic bottom through the end of the year, small value was up about 241%, where the large core was up 187%, which was fantastic, but certainly it lagged small value. The final illustration I'll make relates to bonds, and we've talked a lot about bonds, certainly since 2022, when we had rising interest rates and a very difficult bond market. If you just look at bonds, and I'll just use a couple of Vanguard funds as proxies here. So if you just go back over the previous 10 years, Vanguard's total bond index fund is up cumulative about 16%. Over the same period of time, their core equity portfolio is up about 200%. I'm sorry, the total market equity portfolio is up 200%. So if you look at the last 10 years, you would say, gee, why do I own bonds in a portfolio? Well, the reason you own bonds in a portfolio is during the Great Recession. So from October 07 through March of 09, that total market fund was down 51%, and the total bond fund was up about 10%. So over that period of time, bonds outperformed stocks by 61%. Year to date, in 2025, bonds have outperformed stocks by about 7.6% year to date. So that's the reason, again, that we want to have broadly diversified portfolios with different asset classes that have different risk and return characteristics, and not get too sucked into this line item thinking where we're looking at the individual line items. And according to Joe Wiggins in his blog, the dangers in line item thinking, or some of the consequences of line item thinking, is you can end up with a much less resilient portfolio because you won't own asset classes that, again, can give you some defense in a broad, different economic and market scenarios. Number two, you can end up taking too much risk by concentrating in asset classes that have, again, may do well in the short to intermediate term, but expose you to unnecessary risk. And finally, a danger is that we end up potentially trading too much because we're always going back and forth to the hot performing sector, and we're not staying fully diversified. So those are some of the dangers to this line item thinking. And I'm thinking about this particularly today as we have a lot more opportunities to build more resilient, anti-fragile portfolios by owning even broader asset classes that can provide positive expected returns, but can give us better diversification in portfolios. We have more opportunities than we've ever had, but we have to be careful because if we add some of these sources of unique sources of risk and return, they won't all move in the same direction at the same time. And the goal is not just to maximize wealth. The goal is to maximize the probability of good outcomes and minimizing the probability of very bad outcomes. So as we build these anti-fragile, more diversified portfolios, we want to invest in asset classes, as I mentioned, that have unique sources of risk and return. Focus on the real risk, which is the inability to meet our financial goals. And finally, not get sucked into this line item thinking and to think in terms holistically about our portfolio. So I hope you just found some of those thoughts helpful. I know Joe Wiggins' blog was helpful to me as I was thinking about some of this and reminding me of the dangers of line item thinking because it's easy to do. So as we go through these periods of heightened uncertainty, just remember to go back to your financial plan, think long-term, obviously, and stay broadly diversified. Hope you found this helpful. If you'd like to give me some feedback, you can certainly reach me at moneyandmeaning@tandemgrowth.com. You can find past editions of the Money and Meaning Show, the long-form interview format, as well as some of these perspective broadcasts, wherever you get your normal streaming. And certainly, if you find it helpful, please give us a rating and share it. Thanks and have a great day.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.